Before anybody thinks it's just all over here, in this recap video, I want to cover what's going on with Facebook, Google, and how we can use exponential moving averages with a whole lot more accuracy. So in this recap video, we're going to cover a few things, kicking it off with the NQ. Now, I've got my eye on the Nasdaq because we've got Facebook earnings here on the heels of Google's earnings. And right now, despite being sent lower after the Sohn conference, I kind of jokingly said that Facebook got Jeffrey gun-latched, where he talked about Facebook being a short. Facebook's sitting up now at about 167. Now, this is an interesting level because it sends it right into a zone that it was trading at before. So I'm not saying everything's all rosy for Facebook. In fact, I think there's a pretty good chance we could top out around 169 and just head back lower, and then Facebook could kind of find a range. Now, I don't think everything's all sour. I think that the market told Google something really specific the other day, and it's very different than the thing the market tells, say, the likes of Netflix. And we just have to learn this new reality, which is Netflix, when you spend a lot of money, we're okay with you because you're still a hyper-growth stock, and we think when you're spending money and trying to find all the new great programming that viewers will be addicted to, fantastic. We don't mind it. But Google, when you spend money, we're not so happy. We're treating you more like a conservative, like a blue chip type stock in a world of Netflixes. So Google, the market didn't take to that very kindly. Quarterly, Facebook is looking at really decent user engagement. So when you look at their Q1, things are looking pretty good for Facebook. And, I don't want to get into the numbers because, quite frankly, I'm just really interested in the psychology. But, if you're interested in the numbers, if you're interested in the way Facebook beat the Q1 expectations, what I would recommend you do is check out a site like Estimize, which is what I use, and then look at what Estimize consensus was on the earnings per share and the revenue, and then what the actual was. And these were good numbers for Facebook. Let me refresh this and I'll show you what it looks like. Okay. And, ultimately, what I think is going to be really interesting, and again, earnings per share, actual 169. Wall Street was way down at 136. Even the whisper numbers, which is what I call the estimized consensus, was only 146. So whether you look at the consensus or the actual sort of whisper numbers, we beat no matter how you look at it. And that's, really a big push for Facebook. And then even look at the revenue numbers. So Facebook rallied back up into what I think could be overbought territory. I think Facebook could ultimately head back down. But I don't think it's going to be the undoing of the Nasdaq. Let's talk about the Nas for a moment, and let's talk about exponential moving averages. One of the things that I think chronically happen to a lot of traders are we use a very common technical indicator called moving averages, whether they're simple or exponential. I tend to like exponential. They emphasize more recent price action with a heavier weight. So I think there's a certain recency bias that I love to see in my moving average plot at work in an EMA versus an SMA, or a simple moving average. So what I use are propulsion dots. It's an indicator that I have that plots dots when there's a certain interaction between a short and long-term EMA. It's not about moving average crossovers, but rather when the moving averages could be showing acceleration in price action and or the fact that the moving average is viable support or resistance. And a lot of times traders start to use moving averages in non-trending markets. And one of the most tricky things to do is understand that, one, a market isn't trending, and two, you shouldn't really be respecting most moving averages. An exception to that is the 200 EMA. And the NQ is actually finding its way down to, one, oversold support, and two, the 200 EMA. It's lit up. See, the dots are plotting. That tells me that the acceleration and the quality of the 200 EMA exponential moving average, the quality is good. It's going to be likely at least a pit stop, a good support level when the market heads back down. So I will make note of that. And I think that names like NQ or markets like NQ and ES are doing something very similar with their EMAs. Here's another series of EMAs that are plotting around the 2600 level on the S&P. So think about using an indicator like propulsion dots, which, by the way, are free. These are free indicators that I've made available for TradingView, TradeStation, Thinkorswim, and the Sierra platform, not to mention on the MT4 for those of you that use it for Forex. And if you want to learn more about these indicators, I just want to mention that tomorrow I'm doing a webinar with Danielle here at Simpler Futures called the Futures Freedom Plan. We're going to be talking about some of these indicators that I've been using for a really long time. Exponential moving averages and Fibonacci-based exponential moving averages have been something that I've been using for well over 15 years. And the way in which my evolution of that indicator has now resulted in these propulsion dots, really replacing my EMAs, is something that I think is going to completely change the way you're able to understand trends and when to use these moving averages as dynamic support and resistance. And that's just a taste of what we'll be doing tomorrow, Thursday the 26th, 7 Central, 8 p.m. Eastern. So register at simplertrading.co/freedom-plan, and I'll see you there.